Hello everybody and welcome to this short update on Opendoor. And the theme of the video is really people telling me in the comments that real estate is dead, and really the sentiment on the market, the general sentiment of the market and on Twitter saying, oh, real estate's never going to recover, real estate is dead, etc., etc. And of course, meaning if real estate is dead, then Opendoor is going to also go out of business. But you can see this is not also specific to Opendoor. This is specific to other companies in real estate. I follow another company on this channel called Lovesac, which sells furniture. Well, furniture is dead. Nobody's buying furniture because nobody's buying homes. Just overall negativity, very high negativity towards real estate, and you would not believe that if you look at the stock price of Opendoor, which is up 200% from the lows, right? It traded at under $1, and now it's nearing the $3 mark. So Opendoor is doing really well, although I don't follow the price day to day. And you know, this is surprising because in reality, when you look at the real estate market right now, you can see that it's been in a general stagnating state for 4 months to 6 months, really stagnating. If you look at the mortgages, they're essentially 67%. I personally believe a 7% handle is not ideal. I'd like to get just under that 7% mark. That way people remember the 6% handle. Real estates are pretty much flat. The only people selling homes right now are the people who are forced to sell homes, i.e. you're getting a divorce or you're switching your jobs. That's like the main reason why people sell homes, because you don't want to give up that mortgage at 2.75%. You don't want to give that up. I say 2.75 because my mortgage is 2.75%, so I wouldn't give it up. It's a great rate, and right now, if you have to go out and get another mortgage, it's 7%. So really, stagnation is the theme of the market, not a crash. Not a lot of upside, just stagnation. And what's very interesting to me is that, yes, the real estate mortgages have been pretty much flat, and this is roughly the bank's margin. And if you negotiate it well, and if you have a good down payment, you should get closer to the 6% range, right? With a high credit score, a good down payment, you should get 6.2, 6.3 right now fairly easily, which is essentially the spread that the bank charges you with the 10-year. And the 10-year rate is what we follow for real estate. Why do we follow the 10-year? Because we know that the average person tends to move within 10 years or tends to refinance. And so the 10-year is pretty close to the mortgage rate and the rate of a lot of things going on in the economy. Consumer loans, enterprise loans. The 10-year is really the benchmark because few people keep their loans for 30 years. And you can see the 10 years hasn't moved much, despite the Fed raising, right? Since October 2022, all we've had is raise. Every meeting, aside from the very last meeting, we've had raises in interest rates, but the 10-year is not budging, not moving much. That means market participants do not believe that this crazy interest rate environment is going to stay, and I do not believe it either. If you look, we're at 5% on the Fed funds rate, and right now the CME Fed Watch tool, right, is predicting another rate hike. So first of all, you can see that they really don't believe Powell, because Powell was telegraphing a 0.5 rate hike, like a 0.5% rate hike by year end. So that would be 2 rate hikes. The market doesn't even believe in 2 rate hikes. And frankly, I'm not so sure that the market strongly believes in that rate hike. Okay, so now it's showing 80% chance of a 25 basis point rate hike at the next meeting on July 26. But if you go back just a few days ago, that was a 60% chance. And these numbers, it's still a month away, so these numbers can still change. If we get more inflation numbers, more data, you may get closer to the 50-50 of a rate hike or of a no rate hike. And what I want to say about rate hike is that they're not that relevant right now because the 10-year is barely barely replying to those rate hikes, so they're not relevant to real estate. Really, the market, the bond market is really being immune to this, not really reacting too much. And then also, I think it's important to know that the ease, not necessarily when the rate, when the rates ease, when the Fed eases its rate, it's necessarily going to be seen as a surprise by the media or presented as a surprise, because the last thing the Fed wants to do is to look like it's going to ease or telegraph that it's going to ease. The rate in interest rates, in my view, will be announced to us in an environment where they had telegraphed a hike, so as to not make everybody believe that it's the boom times again, if I may say it like that. But they will stop raising rates. The banking system issues are not fully done. Who knows what else we have under the hood? We had this hidden QE, hidden quantitative easing with the BTFP program that they did for Silicon Valley Bank, and remember all of the bank failures of March. So anyways, I strongly believe the rates are going to drop. And when the rates drop, Opendoor, in my view, is going to skyrocket, because rates dropping means real estate picking back up, and real estate starting again and going into overdrive, really, if we get back to anywhere near the 300 basis point rates, anywhere like that. So right now, the Fed Watch tool is telegraphing this towards the end of 2024. This tool is not very accurate over the long run. It's really accurate 1 or 2 meetings ahead, but past that, it's not accurate. And this is what I showed in my last video on Opendoor. But the whole world is starting to pause. Aside from Europe, which did not pause, right? Was meeting a day after. They did not pause. The Fed paused, technically. Like, the Fed paused right now. So the whole world is starting to pause, and this will, in my view, only keep going as inflation is inevitably coming down towards the 3% mark. They just can't say it. They just can't say that they're going to pause when they actually do pause, and it would create a major surprise. Okay, let me move on. So Opendoor specifically, let's move on to Opendoor specifically, right? So we know that this company is in survival mode, right? The CEO was replaced by the CFO of the company. So Carrie Wheeler is now a CEO of the company. She's a finance person. She was the CFO. Opendoor is now a fully finance-led company, and because it's a finance-led company, they are all about short-term returns and making money in the short run. You may remember my early days videos, like I guess that's okay in the short run, because you don't want the company to go bankrupt, although we'll see they're nowhere near bankruptcy in my view. But, in the long run, I believe this is bad. In the long run, to me, they're going to have to come back to having a visionary CEO like Eric Wu, who actually pays you a fair price for your home, minus the fees you would have paid to a realtor. And so this was a very popular tweet, right? Almost 200,000 views, popular tweet, and this guy was saying, heavily followed account, he was saying that he sold his house on the market for 11.5% more than what Opendoor was bidding. And so what that tells you, assuming a 5% service fee in there, what that tells you is that Opendoor is setting itself up for a 67% margin for every single new home that they buy, and that's because they bake in potential negative home price appreciation, I hear decrease in drop prices, and they're also very picky. And I've noticed similar low ball offers here in Texas on my house when I did it, and even if you go into Zillow, you can see sometimes the offer that you can hope to get from Opendoor, and you can see that it's consistently a low ball offer. Again, it's fine right now in the short run, but as soon as the Fed pivots, I hope that Opendoor will return to really being a liquidity provider and really being a marketplace that facilitates the buy and the sale of real estate, and not going for the short-term high margin. Because if you get lowballed, right, if you sell your home to Opendoor for say, let's be a little more extreme, for say 20% less than what you see them listed at, you're never going to do business with Opendoor again. And that's the point, right? Home flippers, you sell your house to a house shark, to a home flipper, you're selling it once. When next time you have to do it, you're not going to go that way. That's why I just think Opendoor has to be careful to not lowball too much. But nonetheless, right now, that's what they're doing. They're in finance mode. And as I noted in my last video, they're in finance mode because they, I think they still have a lot of trauma from their Q2 2022 purchases, when they bought a bunch of homes at peak in the market, at the peak, and they overpaid for a lot of these homes, and they ended up having negative contribution margin. You can see the old Q2 book, they had 13% losses on average on these homes sold, 5,900 homes. So they lost a lot of money. They lost hundreds of millions of dollars because they overpaid for a house, and because they got caught in this real estate decline storm. But that's behind us, right? And so one of the questions that one has to ask themselves when they invest in Opendoor, especially when the prices were near $1, was yes, they did a mistake. Yes, they overpaid. Yes, they didn't see the Fed coming, and they didn't see the quickest rate hike cycle in U.S. history. They didn't see it coming. They've made a mistake. But was the punishment by the market much worse than what they actually deserved? And that's what I believe. I remember CNBC bashing Opendoor for 20 minutes, and I was just buying Opendoor to make the statement. And that was when Opendoor was trading near $1, right? It's about $3 now. Because the market gets a little extreme. And the truth is that Q2 cohort, as Carrie Wheeler said in the latest shareholder letter, that should be fully gone in Q2. So the last time it was at 92%. They were 92% behind these homes in Q2. When they report next, we should hope all of this negative contribution be done. And if you look at the new book, right, all of the homes that they bought after Q2 of 2022, so all of the homes that they bought for almost the past 12 months, the average contribution profit is at 8.5%. So that's a very healthy profit. And now the company is going back on good footing. Again, they've made a loss. We're moving on. The market is still punishing them because, as the market thinks, obviously no one's ever buying a home again. No one buying a home again. No, that's not what's happening. People buy homes, and this is where I'll do a little tangent on economics, right? You have Austrian economics, which is what I believe in, and then you have Keynesian economics, which is, you got to play with interest rates to push behavior and to motivate behavior. People don't buy homes based on what they think about monetary policy, right? They buy homes because they need a home. They move because they need to move, right? It's human behavior that leads you to buy a home. It's not your sentiment about real estate. And we often get lost at that. People often think it's going to crash. Well, guess what? People are just going to pay more for homes. You're not going to have a choice. If interest rates are higher, you still need a home. So you're just going to pay more. It's going to suck. You're going to spend less money elsewhere, but you're still going to buy a home. Anyways, moving on. But the point is moot because, like I said, let me show that again. The 10-year is flat. The 10-year is barely reacting to these interest rate hikes. And as soon as the interest rates go down, I believe the 10-year will go down because we are heading into a world of QE to infinity, QE forever, just like Japan is going through. That's the only way that those new 2 trillions a year, so those new 4 trillions of debt the U.S. government is going to issue, who's going to buy them, right? Anyways, let me move on. It's going to have to be the Fed. And it's going to have to be the Fed, and it's going to have to be bought with lower interest rates. Anyways, let me move on to a more practical question. So like I said, Opendoor is very picky now. They're making a healthy 8.5% contribution margin. We'll see that puts us right in the middle in terms of valuation. Not the cheapest stock, but not the highest stock either. One of the reasons, of course, for the stock trading close to $1 is bankruptcy likely to happen? I've covered that multiple times in my video on Opendoor. And the answer to that is, in my view, it seems very, very, very unlikely. Because if you look, and let's even assume you just look at cash, right? You just look at cash and you don't look at the equity that they have in their homes, just at the cash. $1.3 billion in cash. Granted, much of that is borrowed. Okay, but they have a credit facility for the long run, so at least for a longer run than what they would be at risk of going bankrupt. So if you see 200 million, assuming a 200 million loss per quarter, that would give them 6 quarters, so a year and a half, and assuming that some of that equity in the homes is freed, right, through the sale of homes, that could be up to 9-quarter runway. So 6 to 9 quarter runway, so between a year and a half and a little more than 2 years worth of runway, provided that they keep losing this much money. But remember, this money that they're losing is going to be due to the remainder of the Q2 2022 homes overpaid cohort. That's the reason why they're losing money. That's going to change as soon as Q2 is over, or at least it's going to be flat in Q2, and then it's going to be positive again in Q3. And if you read the last quarterly shareholder letter that Kerry Wheeler wrote us, I did this print screen. As such, we expect for the second quarter of 2023 to be our final quarter of negative contribution margin. So this should be the final quarter where you have negative cash flow. Right? As our new book of inventory should make up the majority of our resales beginning in the third quarter of the year. So they're going to be making 8.5% contribution margin in Q3 and Q4 and moving forward. So that's good news. To me, the bankruptcy is not going to happen. And you could clearly see that when the stock was at $1, that it was not going to happen. But the market is overly pessimistic. And let me go a little bit more in the long run. What's the prediction? Kerry Wheeler said that multiple times in the conference call. Their goal is to stabilize their sales at $10 billion in revenue by mid-2024 as a run rate, right? As a run rate. So that would mean Q2 of 2024, $2.5 billion of sales. That would be the run rate. And what would the contribution margin be? 7% if you want to be conservative, even though we're doing 8.5% right now. Let's say 7% to be conservative. Let's assume they don't keep lowballing their offers all the time. That'd be $700 million in gross profit. I'm loosely corresponding the two, right? So with an enterprise value of 4.73, keep in mind they are penalized by their debt when I use EV, but for the sake of consistency, I always use EV, enterprise value, for my stocks. So that means the company would be trading at a 6.75 forward gross profit, which would be right in the middle of all of the stocks that I follow on the channel. That's both expensive and cheap at the same time. Remember that this stock has tripled, right? So when I covered this stock 6 months ago, that was the cheapest ever stock. It's not the cheapest stock anymore because this ratio right there has tripled, and there are cheaper stocks that I cover on the channel. Nonetheless, and this is an inspirational company. I think Opendoor has a lot of potential. That is not priced in, that is not baked into the market, because we're in this anti-growth market where innovation and growth is despised still today. I mean, okay, we've had the AI hype recently, and the AI stocks have been going up, but Opendoor it's an innovative stock, but it's not necessarily an AI stock. So of course they haven't benefited, but I believe they will eventually. So what I will say is that Opendoor, even though it's expensive in the numbers, or at least middle range, as far as their potential, I believe it's cheap because what I focus on the channel, right, is a qualitative analysis of growth. Like what are beyond the finance? What are the fundamental drivers of a company's success? And Opendoor has a lot of these fundamental drivers. That's why you've seen me in prior videos compare Opendoor to Amazon in the way they handle things and in the way they revolutionize things. Because what is the vision? The vision is really buy now, sell now, right? You go on the website, you click buy now, you swipe your credit card, pay $1,000, and you've reserved your home. Reserve your home now. And you don't have to get into bidding wars and price wars or anything like that. It's the leveraging of technology to buy and sell a house. You get an offer from them. You do a tour with your cell phone, and you film every room of your house. And then 2 or 3 weeks later, you have a notary come to your house, and you close the house, and you sell the house, and you get a check. Really quickly, very, very quickly. That's in my view, that's a best cost type of innovation. It's a better service. It's fully digital. You use an app. You don't deal with a realtor. You deal with an app, right? Which is what millennials prefer, and a lot of Gen X and Gen Z certainly are much going to prefer that. And it's also cheaper cost, right? It's cheaper cost for multiple reasons. It's cheaper cost because Opendoor is a liquidity provider, and therefore you can coordinate your moves between your old house and your new house, right? Give up the keys to your old house as soon as the new house has been purchased through Opendoor. So they handle all of the transactions. So it's a liquidity provider. So you save a lot of money on things like having to move once, things like not having to have a storage unit. The coordination aspect is a very strong best/cost. Like it's a very strong value proposition for Opendoor, where not only it's better because you move once, but it's also cheaper because you move once. And of course, the bulk of the Opendoor story, and by the way, this is what I always said, I want to be in disruptive stocks like Opendoor, because even if Opendoor didn't make it, one company one day will succeed. And what Opendoor is doing is what? They're attacking the real estate agent fees of 6%. That's what they're attacking, right? When you sell a home, you pay 6%. You pay for your agent, right? That represents you. And then you pay for the buyer's agent. So you pay 3% and 3%. And this is typically paid by the sellers, included in the sale price, right? They're attacking that. They're attacking that amount. And that can quickly be a lot of money when you're attacking that fee. And they're attacking it now by removing 1%. In some scenarios, they remove 2%, depending when you are, where you are, or when you deal with Opendoor. But eventually, what fee will Opendoor charge eventually? I believe that's where the disruption lies, right? It's a classic 0 to 1 move in the space, in my view, just like Tesla is doing kind of the same thing with, say, dealerships and trying to get away from dealerships. I believe there is a play to be made with getting away with real estate agent fees, because anyway, if you buy a house, you're going to be browsing on an app, typically Zillow, maybe the Opendoor app, because they have a pretty good app, but you're just going to be using your app and doing your research on your app. So you don't need the full service that you needed back in the pre-internet days. And that's the same story with, say, dealerships. So to me, it's a highly disruptive company because they have this potential to disrupt. They have the potential to achieve a truly mind-boggling amount of revenue, right? Which then gives them a lot of leverage and a lot of power over the whole sector. Sure, they have very tiny margins, but the revenue could be huge. Remember, real estate is it's the largest sector, period. It's the largest sector ever in terms of transactions, right? And I don't want them to be a home flipper. Right now, the prices that they're paying are home flipper type prices. I get it. The market is worried and scared and has a short-term time horizon, but over the long run, for the vision to appear, which to me, the vision of Opendoor to me is their target is the MLS. Like their target is the entire network of realtors. That's the target. Replacing all of that industry with one application, right? Just like Amazon is doing to retail, replacing a whole sector of retail with one platform. It's a platform. That's what platforms do, or Airbnb is doing with hotels. Airbnb is creating this platform where you use this platform and you don't need all of the legacy setup. You can achieve the same result. This grand vision to me, and that's why I also call Opendoor a binary bet, because if it pays off, the payoff can be tremendous. If it fails with proper risk management, you're good, because with proper risk management, my position is about 1%. So I think I have proper risk management, and if it fails, that's okay. They leverage technology throughout to cut costs. Right, that's I believe what is so outstanding about Opendoor. And let's finish. It's cheap. It's also cheap for that. Let's not forget that even without all of this innovation, Opendoor has a very successful app. Their app is outstanding, and it's highly downloaded, and it's highly effective. So you have a mini Zillow or a mini Trulia embedded within Opendoor, in addition to all of the reasons why one would invest in Opendoor. So anyways, I still own every single share of my Opendoor position. This is this video was a little all over the place because I want to make a quick update. But I've made a very concise, clear case for Opendoor in the early days of the channel. And so if you're interested in Opendoor, you can go see absolutely everything that I've covered on Opendoor, and it's a stock that I intend to keep covering for a while. And thank you so much for watching. This is not investment advice. This is just entertainment. I hope you were entertained. I appreciate all of your likes, all of your subscribes. Thank you, and have a wonderful day.